welcome. On the front this week, transfer pricing safe harbor rules get a stormy reception. And will it be third time lucky for real estate investment trusts? Transfer pricing is the price at which intra-group transactions or transactions between associated enterprises take place. Now, international transfer pricing involves a foreign associated enterprise. By law, transfer pricing must be at arm's length price, and the arm's length measures have been defined by the Income Tax Act. But since it's no exact science and a highly litigious area, revenue in many countries has provided safe harbors, that is, limits within which the transfer price is acceptable. Often eligible taxpayers complying with these safe harbor provisions are relieved from burdensome compliance and documentation obligations. Now, this week, the CBDT in India released draft safe harbor rules for IT-enabled services, KPO, and contract R&D services provided to a non-resident associated enterprise, for the manufacture and export of core auto components, as well as for intra-group loans and guarantees. But low thresholds and high markups could make for rather unsafe harbors, if I may call it that. Well, to discuss that, I'm joined by S. Gayatri of SR, Vijay Iyer of EY, and Rupak Saha of GE, all tax and transfer pricing experts. Welcome to all three of you. Gayatri, I'd like to start with you. In almost 4 sectors now, the prescribed threshold for transaction sizes is 100 crores. No transactions above that will be eligible for safe harbors. And then you've got minimum profit margins ranging from 20 to 30%. Do you think that these are very low thresholds, they exclude a large number of transactions, and that these are very high operating profit margins, unrealistically high?
It's very important to understand what really are the objectives of safe harbor rules across the world and the way they're implemented. So typically, the objective is simplicity of provisions and reduction in compliance for the taxpayer and administrative hassles for the authorities, so that they are able to focus on the larger issues, larger transactions.
All right, that's understood.
And there is a lot of, there is definitely a large degree of predictability and certainty. So based on these parameters, if you were to look at these rules and also having in mind what other countries have been doing, I'm not sure that the threshold limit per se is all that bad. I believe it is with a design, it is with the understanding of what the authorities think is a lot, is a segment which can do with less than normal scrutiny. Having said that, the range, if you look at the profit margins, they are certainly not aligned with what...
So give me instances where, because I think they're impacted, let's say, by ITES, or for large groups like yours, corporate guarantees, which carry a 2% commission,
right.
or intra-group loans, which I think Deloitte did a working out, and they said loans less than 50 crores will amount to a safe harbor interest of about 11.2%. For more than 50 crores, the safe harbor interest works out to about 12.7%, rates which they say are against tribunal decisions and way too high.
Absolutely, they are way too high. So we would take examples. Like I said, globally, there are just a few segments which have come under safe harbor. They are invariably intra-group services, and loans.
Right.
Now, as far as loans are concerned, they do it with a combination of debt equity, thin cap rules, and the interest rates per se. And definitely, the benchmark there is far, far lower because they're invariably linked to the LIBOR. Here we have a very specific case where they relate only to India-sourced or rupee-sourced loans,
right,
which itself lends itself to a lot of, interpretation. So if you were to, extend it to ECBs, say, for example, which are then further lent by way of ODIs, then you're possibly going to compare with the LIBOR plus whatever, let's say 5%, which could just work out to 5, 6, 7%.
All right, let me take that to Rupak Saha. Mr. Saha, GE has several contract R&D businesses in the country pertaining to what I understand software development, or you could even describe those businesses as ITES. I think that's one key point that comes into contention in these safe harbor rules, the distinction between the two, and again your response to whether the thresholds are too low and the minimum operating profit margins are too high.
So 2 things. I think you have asked quite a few questions. So I think the margins are generally in line with what the Rangachari committee has said. So I hadn't seen the Rangachari committee report earlier. I guess their reports have been just now released in public along with these notifications. So the fact is that they have put the margins consistent with what the Rangachari committee has recommended. Insofar as the threshold is concerned, yes, I agree that it's very, very low, and those thresholds are nowhere there in the Rangachari committee report. And I think over there, they are guided by fear of tax base erosion. And, given the way the fiscal deficit is, I have some level of sympathy as to why they have kept this. Now, one can always argue, therefore, whether this will aim the larger objective of the safe harbor by itself, but equally they have to balance so many other variables, including the fiscal deficit.
So
it is what it is.
All right, so you're being generous, Mr. Saha, from a macro monetary situation. But I have to ask you this from a business operational situation, and discard the Rangachari committee for a minute and just look at these margins as standalone and tell me whether these are the kind of margins that safe harbor rules elsewhere in the world require.
No, before I go to elsewhere, so, and while you are asking me to discard Rangachari report, let me stay a little bit on the report. I was also a little bit taken by surprise when the committee report said that for most of these IT software and IT enabled services, the taxpayer themselves volunteered up to 15%. So from 15% they have gone to 20%, and then where the CBDT has gone a little bit way off from the Rangachari report is that they have introduced this category called KPO. The KPO is nowhere to be seen in the Rangachari report. It is actually carved out of the ITES services, where the Rangachari report also said it should be cost plus 20, but as I said, at some point in time, or the CBDT is completely engulfed with the fear of base erosion. And insofar as international comparison is concerned, I agree that we are way off from, I guess, many countries who are attracting these kind of investments. But I also have this new thinking, I guess, and I never used to think this before, but what India is thinking along these lines, many of the other countries are following. And you know this, whether it is this tax on indirect transfer or base erosion and so on and so forth. There are many other countries which follow what India is doing. So who knows after a few years whether other countries such as China, etc., would also look at these kind of markups. All
right, so you're saying we might be setting the lead. Vijay Iyer, my two corporate guests, are playing it slightly politically correctly, if I may say so. And they're also giving the government a lot of leeway for the current fiscal and monetary situation we are in. You look at this objectively for me and tell me whether these margins are realistically possible. Are these on the higher side? Do you think this is fair? Or do you think that even if they're on the higher side, this is the price you pay for certainty if you want safe harbor rules?
Okay, let me start with the interest number. So that defies economics, because the rate of interest you charge is a factor of the currency in which you charge it. It is not based on the source of the funds. So if today I am lending in foreign exchange, but the source of those funds are internal accruals, I still don't need to charge a rupee interest rate. I will charge what that particular currency would justify as an interest rate. So if it's a dollar denominated loan, I can charge as much as what a dollar loan would cost.
Got it.
And not just because the funds are coming from rupees, it should be 11% interest rate. So that really defies economics. Probably there's a thought on saying that probably the opportunity cost of that fund is whatever it is, but then you're not factoring in the currency risk that is being borne by this lender who's now lending in foreign exchange. Coming to the contract R&D classification, I think the classification itself is so confusing that we may probably need an IT expert to answer that question, but I can't seem to figure out what is the classification between the IT services and contract R&D.
Okay.
So the number itself is way too high at 30%, and it is probably more than what even the transfer pricing officers are doing.
Okay.
Similarly, I would think that in contract R&D for pharma, the numbers are much higher than what the transfer pricing officers are doing. They've kind of upheld cost plus 18 in the past, and not very distant past, as recent as January 2013. So to move on to 29% for contract R&D for pharma also doesn't make sense, and similarly for KPO. So these are the three numbers which are way too high.
All right, I'm going to come to you, Gayatri, with a very basic question. If the entire attempt is to reduce litigation in the transfer pricing space, do you think this is going to work? Is it going to do enough?
I certainly think that a lot of tweaking is called for. One basic thing is certainty. I mean, one of the hallmarks of a safe harbor regime. Just look at how it's been prescribed. It's for 2 years, of which 1 year is over, and half of the next year is
1 year
over.
is currently the year that's going on.
Almost half is over. So you have a retrospective situation on the other hand, and standing today, one cannot be sure. Even if, let's say, one says, okay, I'll give in to 2%. What happens to the previous years when one went for a 1% to no commission at all? Can I still, dispute? Can I still challenge? And then again, what happens after the next year? And the other one being simplicity of provisions. Let's say an assessee, once again taking the same example, says 2%, fine, files a return. The assessing officer takes it up, let's say, after a year, and then says, oh no, I don't think you quite fit into this, you aren't eligible. Then he goes back to the regular assessment. He might not even, or if it's, let's say, a 30%, having accepted, even if he is not charged, he pays up tax. At the end of it, he doesn't know why did he have to pay tax in 30? Maybe in an earlier year he had paid 25. He can't defend that. He doesn't know what to do in the future. So it's all,
So
one
these are
mixed
not tweaks. This is a redesign, Gayatri. You politely called it tweaks. All right, Mr. Saha, one of the big concerns that I've come across in all my conversations is several consultants as well as tax heads telling me that will these now reasonably high operating margins be deemed as arm's length, in the months to come or in the years to come outside of safe harbors? Is that one of your key concerns?
No, I think that risk is certainly there now that these are in the public domain, as well as I am saying that since these are so blessed in a way by the Rangachari committee report, it has given a shot in the arm to the revenue by saying that, look, these are probably the best benchmarks which we should work on. And not only the revenue authorities, I would think because the committee report comes up with these rates, a lot of adjudicating authorities, including the courts, would be influenced. So therefore definitely there will be a problem with the taxpayers now to justify something which is significantly lower than these benchmark rates. That's for sure. Let me very quickly also talk on this corporate guarantee and intercompany loan. My sense is that the government sort of should have perhaps refrained from coming on a safe harbor at all in case of this intercorporate loan and guarantees. I think those kind of safe harbor works where the currency volatility between two countries are kept at a minimum. But given the currency volatility we have, it's very difficult to negotiate issues of the type which Vijay mentioned. So for example, while Vijay said that, if it is a foreign currency loan, it should be benchmarked with an international benchmark. But then the other concern on the Indian side is that, when you are borrowing from Indian funds, you should at least make a positive contribution out of your margin. Now, what I was quite taken aback in the Rangachari committee report is that they think, or according to that report, the entire cost of funds and the opportunity earnings around that, they premise that should be met by the interest earnings from the loan. Now that is wrong because, in this basic economic concept of interest rate parity, the lender's return would have probably been met by let's say if it's a dollar loan, the dollar rate of return plus the INR depreciation against the dollar. On the corporate guarantee, perhaps, the 2%, I think there is a little bit of a rationale considering that, again, the committee report says that most of the banks, they charge around that type of fee for any guarantee commission. So that's the benchmark which they are taking.
All right, Mr. Saha, you're picking up steam only now. Unfortunately, I'm at the end of time, so I'm going to move it on to Vijay Iyer for the verdict on these safe harbor rules.
Certainly, it's a positive move from where we were. It took us 3 years to get this out, so at least we've got something out now. We've got a pretty well-written Rangachari Committee report which sets the tone for this circular. So we can talk in the context of the Rangachari Committee with the government and say, look, this is what they've said. They've raised a lot of doubts about these numbers, and so like the 30% number is not there for KPOs. There is a 22% for BPOs of a certain scale. So there's some points there which we can bring it back to the table and have a discussion. I would expect some level of rationalization of this whole thing, and if that is done, I think that will be a positive move. We don't expect 100% of taxpayers to buy into the safe harbors, but even if we get 30% takers, I think that will be success.
All right, Vijay, I'm going to treat that as the closing comment. Vijay, Mr. Saha, Gayatri, thank you very much for joining me. I know there's so much more to talk about when it comes to safe harbors, but that's all the time we have on the show. With that, I'm going to take a quick break. Coming up next, will it be third time lucky for real estate investment trusts?